Hello everyone, welcome back to our valuation series. This is our 11th video in which I will be talking about systematic risk and unsystematic risk. Do you fear suffering loss when you invest, not getting your capital back, or that the global recession will lead to an unfavorable situation to your hard-earned investment corpus? These are the situations that are risks associated with your investment. Invest less and earn more is the base of every investment in the world. But there are always a set of risks assigned to your portfolio irrespective of where we invest. Risk return trade-off explains higher the risk the factor, the greater the reward. Does the potential of taking higher reward means you have to take an absurd amount of risk? Most definitely not. However, if you are looking to increase your rate of return, you need to take a certain amount of risk. These risks are inevitable and accordingly one should be equipped to handle them. So what are these risks? Let's learn about more what is making our portfolio turn red. The two types of risk are systematic risk and unsystematic risk. Arithmetically, total risk equals to systematic risk and unsystematic risk. Systematic risk is non-diversifiable in nature, which arises as a result of various external factors such as political, economic and sociological factors. This means it cannot be controlled or minimized or avoided by the management of an organization. It is there for the whole market to bear. Systematic risk affect the entire industry or an overall economy into a distress. Beta is a measure of the volatility of this stock with respect to market. Market risk results from the general tendency of the investors. For instance, investors avoid investing in best performing companies during the financial crisis. This was seen during the pandemic. The stock market indices had fallen by around 50%, after which it corrected itself and today has reached to its all-time high. Inflation risk results from the decline in the purchasing power due to inflation. For example, if inflation is 5% per year, you need 10.50 to buy the pack of pens next year that costs 10 today. Unsystematic risk, known as non-systematic risk. Specific risks are unique to a specific company or industry. These risks arise due to various internal or external factors that affect only the particular organization but not the entire market. Unsystematic risks are avoidable, controllable and diversifiable in nature. The major source of such risk are finances, business operations and insolvency. And the common example of the same are a high rate of operational costs, a rise in labor turnover. Business risks include any internal factors that affects company's revenue and performance. For example, suppose Fund X has 15% exposure in the agriculture industry in Europe. Due to low harvesting conditions across Europe, commodity prices have jumped up, followed by a slump in demand and reduced yields for the farmers. Sustainable growth rate refers to the growth rate of the company when the capital structure adopted by the firm remains unchanged. Therefore, if a company has return on equity of 10% and it retains 80% and distributes dividend as 20%, the sustainable growth rate is 8%. The company can grow at 8% per year with same structure. If you have any questions or feedback in our videos, please leave them in the comments below. And don't forget to like, share and subscribe to our channel for more such videos. Till then, stay tuned for our next video on the valuation series.